Hey everyone, AI stocks have been soaring lately, and so it's not surprising that investors are interested in AI stocks. The two I'm going to consider in this video are Supermicrocomputer and Snowflake. Supermicrocomputer stock has already surged. So would it be better for investors to buy Snowflake stock instead of Supermicrocomputer if you want to capitalize on the AI trend? Well, that's the question I'm going to answer in this video, comparing these two stocks across several critical financial metrics, including their valuation, to answer that question. So let's jump in and check these two out.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing I'm going to compare these two AI stocks on is revenue, and you can see Supermicrocomputer has accelerated growth, 9.25 billion in the most recent trailing 12-month period. In fact, in its most recent quarter, it grew revenue by 103%. Snowflake has grown more steadily, 2.621 billion in revenue in the trailing 12-month period, and we're going to see over the next few years, Snowflake could have better growth prospects. You're going to see an interesting trend here forming for Snowflake and Supermicrocomputer. The next thing I wanted to highlight is operating profitability. Supermicrocomputer, profitable, 9.4% operating profit margin, although no clear trend upward. Meanwhile, Snowflake is negative. It's losing money on the bottom line, negative 40% operating profit margin. But that trend has been moving upward. It's been making progress towards profitability in recent years. I want you to consider the importance of the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand more about this metric, you can see Snowflake clearly outperforming Supermicrocomputer here. 27.51% compared to negative 1.47% for Supermicro, as the company has had to invest in inventory to prepare for its massive surge in growth in recent quarters and going forward. Snowflake, meanwhile, mainly a software as a service company, a data company, doesn't deal with inventory, physical inventory, so that's primarily why its cash flow from operations is much better than Supermicro, even though Supermicro is more profitable than Snowflake. Also, Snowflake trend is moving upward and to the right, heading in the right direction here for Snowflake. Okay, I also want to look at the next 2 years, 2 to 3 years, their forecasts and prospects for these two. So you can see for the fiscal year 2023, which ends on June of 2024 for Supermicro, expectations are that it completes the year with 103% revenue growth and 85% earnings per share growth. A very good year expected, to be sure. That's expected to slow down in fiscal year 2024, which ends in June of 2025, where it's expected to grow revenue by 34% and earnings per share of 30%. And then a real slowdown in fiscal year 2025 that ends in June 26, with growth of just 3% revenue and 9% earnings per share. Snowflake, which according to this forecast is expected to grow revenue by 30% in fiscal year 2024, with earnings per share growing 41%. And then for its fiscal year 2025, revenue accelerating a little bit to 30.7% and earnings per share accelerating to 54.9%. So while Supermicro is expected to slow down in terms of their rates of growth, Snowflake is expected to accelerate in terms of their rates of growth. So differing trajectories here for Snowflake and Supermicro, although Supermicro has surged in recent quarters and in 2024. In 2023 and 2024, its fiscal year is not the calendar year, so it's a little bit confusing. But in recent quarters and its complete fiscal year, the current one, it's going to thrive. And so interesting differences here from these two AI stocks. Finally, I wanted to compare their valuation. Snowflake is nearly 5 times as expensive as Supermicro when measuring by the forward price to earnings ratio. Snowflake is trading at a forward PE of 132, while Supermicro is trading at a forward PE of 28. Now, if these two were trading at the same valuation, I would pick Snowflake, no brainer without a doubt. However, Snowflake is more than 5 times as expensive, or roughly 5 times as expensive as Supermicro. So the valuation is what makes the difference for me in this case. So if I was to pick between these two AI stocks, I would pick Supermicro simply because of the valuation. Now, I admit that Snowflake deserves a premium valuation over Supermicro because of the better prospects longer term, because of the better business model in terms of being a software as a service versus selling physical goods, things. And so its prospects for profitability, profit margin are much better longer term. It has better potential longer term than Supermicro, which after its initial surge here in its current fiscal year and then a little bit continuation next fiscal year, the growth rate is expected to slow down. However, I don't think Snowflake deserves the roughly 5x premium valuation. So for that reason, if I was to pick between these two AI stocks today, it would be Supermicro. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.